Alright guys, glad to have you on board again today. This is Wednesday and it's been quite a while since we have updated our regular framework for flow tradings and some more like range, short-term expositions and intraday trades. And basically, the reason why we've done that, I hope was clearly explained back then, is that, we needed to put these things into pose as the underlying flow structure which we're in different assets that we've been following as an example in here, we're kind of in a steady upward trend mode, which was basically there's no reason to fight against that, so just let yourself ride that trend and live it that way until we have clear evidence of signals for us to take profits. And that's exactly the reason why I'm recording today, because I think we have the early signs of potential profit takings to come along the way. And just like you should always be proactive with the market, which means you need to be ahead of it, you need to know what your next move is and what you want to see to act upon these things. Never react to the market in a sense like, this happened, now I'm going to have to do this. Okay, so that's really how it goes. This happened, then my next move is going to be that. All right, always one step ahead. Know what you're going to be doing, just don't react. Okay, so therefore, a quick recap on where we are and where we stand regarding the assets that we follow. So S&P 500, and we're going to do the couple of crypto headliners, Bitcoin and Ethereum, and then we're going to go through the commodities. So that's really how it goes. Same program as usual. We're just going to catch up on the kind of 2-month period in which we stopped doing it while we waiting for something to move on that front. So since that time, the S&P 500 has settled durably into the all-time highs, held candle closes and stuff like that. We're now trading into the resistant context. So we are in a monthly reference back then. That means now flow trading can only be 4 hours. And just to set things straight, back then when we had that consolidation here, when we started triggering buying flows, therefore we was in the weekly reference. Remember that's the reason why we've traded it into the H1 time frame. Now we've also assessed that during the time we traded that, there were kind of intrinsic similarities with the potentiality to trade it in the H4 time frame. Remember, we saw that it was working H1, but we could have traded as well somewhat of an H4 flow sequence. Well, now we have the answer of this because the market trading in all-time highs means the sequence of the flow was actually 4 hour. But we couldn't have known any of it back then. And it's really, really what we've emphasized greatly at the time is to say you trade what you see, because it's always easy to reconstruct the things down the line when you see what the future was, what the future is. So it's always harder to put it into framework when you have it in real time. So remember that we had no clues back then to trade it for the H4 time frame. We had to do it H1. And then we've proven through an entire year-long follow-through that it was actually profitable anyway. And that's really what needs to be assessed out of this. So that was just a key takeaway. Since then, as we now know everything about this story, there's one thing we know for sure. We're no longer going to trade H1 time frame. We're definitely back down to monthly reference here, though everything we look for is in a 4-hour sequence. So now we switch to intraday modes. This is the reason why I'm taking the cash market flow in here. The futures market derivatives. And that's really the way to go. So if we go in the 4-hour chart reference, we would see that the third flow on the H4 time frame here is now way overdue, into the sense that if you look at the structure of prices, we can see that there's already a lot of unfolded context boxes signaling that we might have overextended this rally, and now a consolidation is more than overdue. So we left each other, if my memory is right, mid-January or so, and since then the only thing that happened is just destroyed volatility, straight line up, 45-degree angle kind of washing machine, and anybody who's been trading against that has just been destroyed. So that's really the way it goes. This market has gone up, totally destroyed cyclicity, and we're waiting for evidence for this thing to finally terminate. That means whoever is trading that flow just need to let itself ride that thing until it reverses. By reversing, I mean you need to see the context going into the opposite direction, build a third range boundary where you will profit take your system, and that's how it goes. So remember, that's really how these things need to be played out. Now that we're in the 4-hour reference, if you still have those trades, you need to know what the final signal will going to be, and we're pretty much approaching this as we speak. The reason why I'm saying this is because, of course, as we terminated the sequence of 3 flows, headed into all-time highs, the next following formation, this is going to be a couple of consecutive corrective flows before something happens. It could eventually even be a bear signal with a sequence of 3 flows, which you know of, but you also know one thing for sure, you're never going to trade the first flow. You're just going to let this one happen. Don't be among those who try to catch the markets up. Remember that when the market is making either all-time highs or all-time lows, doesn't matter. Anytime we're trading into historical prices, you should never try to trade against that, okay? In flow sequence, the first flow is the one you need before considering trading the second one. So TLDR in here is that we terminate a 3 set of sequence for flow in the 4-hour chart, which means likely opportunity now is to let it breathe out for a couple of consecutive bearish flows. You're never going to trade the first one. You can eventually start trading the second one. To get the first one, we need to have the moving average, which is at least flat or slightly consolidative, okay? And you need to see the resistance context here falling below that moving average, okay? So that tells you 2 things that you need to have to happen. First is that the prices, if you want to reverse the context, need to reverse the context. And the second thing, if you want to see the moving average going flat, that means we need to see prices trading below it. That's just the way it goes. So for now on, we're still trading far above this moving average. So I would tend to say, if you want to set yourself some kind of alert in where things could start to be interesting eventually, so there is a couple of things you can do. You can do this, basically prices crossing below the moving average, but it's certainly not going to be a trading signal for you. It's just going to be, okay, we've reached intermediate maturity. We're starting to have somewhat of a consolidation. Then I'm going to be ready to take my profits anyway. The first thing that I would suggest doing is, for example, taking in here your framework and just to say, I want to be alerted when we reverse the context. So that would be using Pro Alert, sorry. We're going to do it with the right way to do things. So that would be, okay, taking channels. It's just me switching my presets. So give it a second. Okay, so we're going to take Pro Alerts and we're basically going to say, okay, I want to get an alert when the channel is falling and I want to do it in a context time frame. So that's basically going to be it. It's just a single set of alert. That's just as simple as it is. And I'm going to trigger an alert for that. Okay, so that's going to be, okay, get me an alert onto this thing. All right, I want to just trigger my alert. So that will be it. Whenever the context reverse, I will have my alert triggered. And that will be the sign for me that I would like to take my profits on the coming pullback afterwards. When we do the 3rd range boundary, take your profits, get out of this. That's all there is. Of course, then you let the market consolidate. And when we have it to pull down below the flat or falling moving average will be the sign that we have our first flow, okay? So that's what we want to see. Once we have that first bearish flow, okay, this is the kind of first corrective flow, we're going to wait until, of course, we retrace, make a 3rd range boundary, and have either the moving average or the Bollinger Band, and this is where we're going to start trading this second flow. This one is the one we trade, remember, and the first one is the one we just wait until it happens and we don't try to profit out of. Okay, that's how it goes. That's just pure and simply this for the S&P 500. That's the plan forward. And for now on, we just need to have proof of maturity that this thing goes into creating the first flow. And there is profit taking, of course, in the meantime, for those who haven't done it already. That means, well, you're going to have to take your profits on the forthcoming 3rd range boundary before the first flow kind of set itself. Okay, so that's how it goes. This is all you need to be monitoring now. And you should know all the technicals that needs to follow suit in order to play each and every of those maturities. Okay, the reason why I've started recording this thing today out of 2 months of basically silence is because, well, we have, I guess, early signals coming from more speculative markets, the Bitcoin and Ethereum's, starting to have their consolidation on their end. Remember, the flow sequence in here is somewhat similar. It's in the 4-hour chart, but it's a different maturity. Remember, the cryptocurrencies are trading their second flow in the sequence, not the third, which means there could still be a third one to go by then. And these ones means, well, you remember that the third flow always plays itself on the Bollinger Band. Okay, so this one means you're going to have to wait for a serious amount of time. There is still upward potential, but you really are going to have to be patient for this. Because if you look at it, the current Bollinger Band for Bitcoin is basically now at 27 $1,000, we're trading at 63. So we're pretty damn far away from there. Though the reason why I have acknowledged this and told you that the likely probability onward for Bitcoin is, and same word for Ethereum, is to see somewhat of a Wyckoff pattern, then this is the reason, one of the reasons that we're backing those claims, is to say, looking at the underlying structures maturity, we still have a third flow to go by. The target for entry is going to be the Bollinger Band, but the distance we face with these current levels today means, well, we've exploded volatility. In here, you can clearly see that with the fact that we had hell a lot of volatility alerts. We fucked up the context so many times in a row. So that's really the way to go. I think that now only one thing is going to happen. After we expanded the volatility dramatically, we're going to contract it significantly. Because for us, anyway, there's not going to be anything to buy in crypto until we get that Bollinger Band. Remember that Bollinger Bands are totally price dependent and volatility derivatives. There's no way you can predict at which point in time and at which predictive level we're going to be buying Bitcoin. All the things we know is that there's nothing for us to be taken care of until this plays out. So get it to play out. Don't try to play your tinfoil hat stuff or whatever, like it's going to crash, it was all just fake and whatever. Just try to put it easy on you guys and to say at the current given time, you wouldn't be buying Bitcoin until it retraces to 30K or so. And I don't nearly think it's going to happen. So we're just going to have to acknowledge that some time and some serious amount of time is going to have to pass now. Because to the point that we are now, these are weekly Bollinger Bands, okay? And they will update each and every week. And I tend to let you believe that the easiest way to get a buy signal in the forthcoming future is to slash this volatility immediately. To basically stop going up and down, pump and dump, whatever, but just do absolutely nothing. The most efficient way to get to the next bullish signal is to go flat with the lowest possible amount of volatility. So the most efficient way onward for Bitcoin to maintain its valuation ahead of the third flow is the Wyckoff. It's to basically spend time into doing nothing or doing the least possible amount of market moves. And the easiest way to do this is to create a Wyckoff pattern. So that's exactly the reason why I advocated for this probability. It's basically repeating what we've done in here between the first and second flow, is absolute flat boringness in very limited type of market amplitude until we get to create those flat squeezed Bollinger Band structures. And I think that's exactly what we're headed for, okay? So be ready for this. And the reason why I'm mentioning this is because despite all of it, the stupidity that we've seen and the volatility that we've seen, we are now reversing, or at least headed to potentially reverse those contexts in the Bitcoin market. Same thing goes for Ethereum. That means for those who've traded the second flow, okay, we had somewhat of a warning in this area, but the contexts weren't reversed. Remember, if you put yourself back into context at that time, you will be seeing that, okay, give it a second to plot. Come on. That's the intermediate 50% line was always blue. That means the contexts were not reversed. So this wasn't a third range boundary opportunity. So you needed to let yourself ride that area and just see for what it is. And it didn't reverse. Even worse so, it accelerated significantly out of this area. The point which we're in now is that the market is freakingly excessive in terms of price structure, and it's very likely going to reverse the context this time around. By reversing it means the same story as we've seen for the S&P 500. The next move to happen there is going to be a third range boundary afterwards. So that's kind of the next move for the cryptos, is to reverse this context, have people take their profits to get out of this massive gain structure. And out of this, well, the simplest outcome that's going to come out of this is probably nothing, which means once we get it done, there's no reason for this market to crash. I mean, still, this could happen, but otherwise, I very much plead for absolute boringness, kind of destroying the volatility that we've created. So exactly the same thing as happened for Ethereum. Okay, that's really the way to go. We've gone higher, never created the third range boundary. We've gone straight line up, accelerated dramatically on the final stages. As you can see, the differences in terms of structure that Ethereum didn't play out with the stupid volatility alert for Bitcoin. So Ethereum has been having somewhat of a much better type price structure, I would say so. So some people said Ethereum has lagged or whatever shit that is. I would tend to say if we look at the price structure, Ethereum has done a much better job at pulling prices up without going too stupidly volatile against Bitcoin. So the price structure in here is kind of somewhat better to me. The thing is that it's still the end. It's the same thing. We have gone context to context with very high likelihood to reverse the context, and the same thing is going to happen afterwards. Third range boundary is going to come. That's going to be the take profit signal for people that have been traded upwards. So put it simply out of you guys is to say, well, what we have here is not necessarily a sell signal, okay? That's just a profit taking. So put it clearly onto your guys' head, okay? It's not, okay, I'm going to sell. It's just for those who want to trade that third range boundary, I think it can be done. But it's mostly for those who've been trading all this thing all the way up, this is where you lock on your gains and move on to something else, okay? We terminate this second flow structure. What's going to happen next is, of course, same story. We're going to have to wait until the Bollinger Band, which is currently standing at $1,500, is going to have to catch its way up to prices. Okay, so that same story. In order to flatline the moving average, we're going to have to trade below it at some point. So just let it play out. Don't try to play God. All you know is that let it play out for the foreseeable future. In here, probably another couple of months, potentially even 3. Ahead is the bare minimum time we need, and we rather like to contract volatility rather than see it going all the way up or down. So same thing goes in here. The probability of Wyckoff pattern are significant. All right. And finally, last but not least, a quick look at our commodity markets, which we've been following. In here, the timeframes are much, much larger. Remember, we're probably 3-month to 1-year-old kind of ranges due to the long duration in history for these things. Reason why we know that the flow sequence is in the daily chart, potentially even weekly, because we have the same possibility. So remember, the S&P 500 means we could have traded the H4 or H1. We always choose the lower time frame by assessing also that this lower time frame can be a bit aggressive. So if we look at it anyway, for USD WTI, quick catch up on this, we have this big massive first flow. The moving average is falling below the context. That's really the way to go. It's a big massive first flow, pretty excessive and volatile by the way. We've got the huge consolidation that follows suit. We've got the third range boundary, either be there or there. People can still argue on those. And as you can see in here, we have totally flattened out the Bollinger Bands. So the Bollinger Bands are absolutely ready to squeeze compared to the volatility that we had back then, the width of these Bollinger Bands. We're now trading at a significant discount of volatility. So the truth is that in here, no matter what happens is we have the third range boundary. You could either buy the moving average or the Bollinger Band. As you can see, we've gone close to the Bollinger Band, but not yet there. So we could still go there. The other way around this is to say, well, we've traded for quite some time. We're ready to squeeze oil. And if it starts going up, that's going to be the interesting move. Anyway, this thing doesn't validate the second flow until we get to 128. That's kind of a significant move to plot out. That's somewhat of a 60% price increase. So bear that one in mind. It's probably going to happen. And if it does, then you don't want to be among those who will say, no, that's not good, that's not rational, whatever. Just trade what you see and try to be dumb. Whenever we do those flow sequence stuff, you repeat the sequence and you try not to overthink things. So that's really the way to go. From what we've seen so far, if we just delete the price action to just try to extract the signal from the noise, we would tend to see that the market has attempted several times already to try breaking out and trigger this kind of second flow, always facing some near and severe resistances. So this time around, we're trying again. We have an expiration for this target by the 9th of April or so. And question is, are we going to succeed at breaking out of this and expanding the potential Bollinger Bands, which frankly speaking look like they're squeezing? Or are we going to go all the way down? That means afford yourself into a significant pullback in oil that could go right back down to 70. I goddamn don't know. All I know is that anyway, even if we go to 70, my trades will remain as they are. And if we finally get to break, I don't give a fuck about what's going to catalyze that and trigger the move, but I'm going to let it behave. So that's how it goes. There's nothing in here in this market to say until we get ourselves out of this second flow validation, 128. It's just that I'll do a somewhat risk limitation and profit taking in the big range, somewhat at 113. That's how it goes. So at 113, I'm just going to partial profit take, and the rest of the trade is going to be set at break even and let myself ride that stupid wave if we go to 130. Okay, silver has a somewhat similar but slightly different picture is this one. So remember how we are, same story in the terms of actual scale. These are long-lasting value areas in the quarterly basis, eventually even yearly. So the flows in here trade on daily and weekly. We see those first flows in here as well. First flow, big move above. So as you can see, the first move was kind of violent. The second move, of course, is going to be a relative. We don't know. It could be bigger than the first one, could be smaller. All we know is that it's going to have to break the previous all-time high. So we expect silver to trade above 30. Doesn't really matter how long it takes to get there. Now, if we remove in here the noise from the signal, we of course delete the prices, and we see, oh boy, quite a lot of oscillation in this market. It's really, really staggering. We've had the third range boundary as a delay in here, and we've never ever succeeded to go back there again. So this is a key element signal in here. Remember that if we ever go back 28, this is where the breakout will start to occur. Until then, we've just created an overly mature range. It's incredibly mature, like really, really incredibly mature. And out of this, well, we've created so many swings and fake signals, and along, as we can see, the moving average hasn't been the supportive area for this second flow to trigger. We've gone all the way down to the Bollinger Band. We even rattled them for a little while, and that's how it goes. From now on, we've just kind of waited for this to happen, kind of sometime falling below the moving average, which is now totally flat, and we're waiting for the appropriate moment in which this thing triggers. The thing is that, just like we stated before, just look at how many breakout signals have happened there. All breakout signals for range context. So just staggering. But we would note this time around that we also had hell a lot of bearish attempts. So that's the reason why I said, for those who are trading silver, it hasn't been an easy sail out there. It was really violent, and we faced a mere violent opposition in here. By those people trying to take down stop losses all the time. So remember, if we're in a bullish sequence for silver, this is the sign of people trying to take down stop losses, and it's clearly visible. So like I said, it wasn't an easy trade, neither for the psychology or whatsoever. It's really a trade in which there are opposite forces, but this time around we have something. This one isn't a range breakout. We have a clear night breakout, and we're getting through this as we speak. We're traversing this thing. So if this time around is the good one, and if we get to succeed through this, I think that's going to be the actual market catalyst. Remember that if we get to trade above 28, 26, this is where the previous third range boundaries are. This is where the things will start to shine. So for silver, I would tend to say if we ever get closer to 28, this is where all the bears will have to close their trades. They tried, and if they failed, they're going to have to stop loss their trade. So this is where I think we're headed. I don't know what's going to trigger this as well. Just like WTI, don't try to overthink things. We're in kind of somewhat long time frame, so it could still take weeks, months, quarters to play out. Could very well be yet another fake signal. But for now on, this one seems to be pretty favorable. So I would tend to say, very carefully looking at those commodities in the foreseeable future, what we tend to say is that they seem to be negatively correlated with the rest of the assets. So that's interesting to see. So could be a nice, interesting opportunity to hedge your portfolio exposition by having those equities kind of correcting, but in the same time you would have those commodities finally going bonkers. So that's all there is. Regarding silver though, this is the same old story. You can't put your stop at break even. Only do so when we break through the $29, and so this is where you put all your stops at break even, let yourself ride that trend and figure out the targets have anywhere to be but above $30. So that's how it goes. There are some imaginary target projections that are going to be around the $34 mark, otherwise 43. And remember that we're going to let ourselves ride that thing until we get the third range boundary. So that's how it goes. That's how it is for me for commodities. And of course, remember, we're just doing this to showcase how this thing works, and how you can, of course, use it into any other asset being out there. So that's how it goes. Just kind of setting the basis again ahead of the next weeks in which I expect to restart those regular intraday weekly updates. Based on the fact that, of course, we are starting to neutralize them. But remember that the market decides on its own. There's nothing for us to be leading the market. So it's really how it goes. We know what we're going to do next as of what the market will deliver. For now on, I gave you my kind of forecast. That is, we're probably going to build a third range boundary. At least that's the next kind of signal we're going to look for. That being said, I'm going to leave you guys with that. Have a nice day and see you soon. Bye-bye.